Welcome back to another episode of FPOG, Financial Planning for Oil and Gas Professionals. This week, we're going to talk about the case against private equity. And Justin, I feel like we should elaborate more before we just go swinging punches like this. We've talked in previous episodes about alternatives, but in future episodes, we want to kind of dive into each one in a little more depth, because that episode was more of an overview, kind of philosophical orientation about, hey, how do we think about alternatives at the 30,000 foot level? Alternatives are different. That's like saying, how do we feel about equities? Equities are so different. So I wouldn't say we're anti-private equity, but I would just say proceed with caution. This might be a better title for this podcast might be things to be aware of when investing in private equity, because I think it's terrible financial advice to say always or never, right? So private equity is always a bad idea, or private equity is never a bad idea. I don't think the truth is in either of those extremes, but somewhere in the middle. But I do think it's an interesting asset class and one that has a lot of pizzazz connected to it. Justin, I think before we get started talking about private equity, what's the first things you think of when I say the words private equity?
Jared, I think this will tie in well. The first thing I think of is hype and popular. And it's easy to hear those things and kind of hear that I'm saying that it's overrated. And again, Jared, it's you said this. We're not against private equity. We are for it. Frankly, it's a good thing. We help clients vet private deals a lot. And so, as we've said many times on the podcast, it makes sense to pursue asset classes with different liquidity profiles, volatility profiles. And, at the end of the day, Jared, it makes sense to own asset classes that are not all correlated to public stocks, especially as assets approach 10 million and above. But Jared, I think that's what comes to mind. And I might say that we're trying to right size the way that we think about private equity. It has become so popular, and we are going to look at this from an investment lens. Jared, we've talked a lot offline about how much private equity has operated in our space. So if you're listening to this, you probably know that we own a fee-only wealth management firm. And private equity has been buying firms like ours left and right. I mean, it has been a massive movement for about 5 to 10 years now in our industry. And, Jared, we often joke that anytime private equity buys a financial planning or wealth management firm, it is terrible for the clients. It is terrible for the employees. And it is intended to only be good for the investors that are part of that deal. And so, there are certainly drawbacks within companies that are owned by private equity, drawbacks for their customers, drawbacks for their employees. But we're really going to look at this from an investment lens, meaning should you, as a private investor, think about investing in private equity?
Yeah, that's exactly right. And, a lot of this is frameworks for analyzing private equity deals. I think or just understanding the asset class more generally, but I think having an orientation of caution, I think will help you make better decisions, right? Because private equity does sound exotic and sophisticated. It's like what all the accredited investors, qualified purchasers, right? Like there's some panache to it. So it's easy to get sucked into that, but it is worth taking a step back and being like, okay, how do we think about this from an investment lens perspective? So I think, I like your definition of this episode better. Hey, let's right size private equity. So one of the ways we right size it, I think it's just say, hey, let's call it what it is. And it's leveraged small cap investing, right? Like if you think about the average private equity firm, if you think about there's a bunch of different types of private equity, but like one of the biggest forms of private equity is leverage buyout, right? A company identifies an opportunity in the market, purchases the company, and uses debt financing to purchase that company, right? So, they have 25 cents. They're buying the company for $1. They only put up 25 to 50 cents, and the other 50 cents is financed, right? So you'll see a lot of illustrations that compare private equity returns to S&P 500 returns, and point to that as hey, private equity is better than the S&P. And it's if you're going to have that conversation, that's that's not even the place to start, right? Because you're A, investing in small companies way smaller than the S&P, and B, you're applying leverage to that. And I think that's a better comparison, right? Like just to say like, okay, hey, and then the second piece of that becomes, hey, if the beta or market exposure we're comparing ourselves to isn't the S&P 500, but leveraged small caps, how have those performed versus private equity? And so, Alpha Architect is a quantitative asset management firm, and they did a study comparing rolling returns over various 10-year periods. So 90 to 2000, 91 to 2001, right? Since 1987 to 2014, they compared a leveraged small cap value portfolio to private equity. And over 10-year rolling periods, over that 30-ish year time horizon, the leveraged small cap portfolio outperformed private equity 72% of the time. And of course, we'll link to the studies in the show notes. But Justin, does that surprise you? And then how do you feel, comparing private equity to leveraged small cap equity, and anything else our listeners should know about that?
That's a perfect comparison, Jared. What an awesome data set from Alpha Architect. This is so fascinating. So again, if you repeat the main idea in 10 seconds, it's that private equity is effectively similar and in majority of the rolling 10-year periods worse than leveraged small cap investing. And Jared, I think that is an interesting call out, right? Leverage. When you apply leverage to a good investment, it becomes a great investment. Now, on the other side of the coin, if you apply leverage to a poor investment, it can really blow up. But what a perfect comparison. That's super helpful to kind of, again, right size it and have the right perspective that you're buying small companies and you're typically using leverage. A lot of people really look back through personal experience today and say, man, I wish I would have bought more houses. Right? I wish I would have bought more real estate. I have this experience of buying my primary residence in Houston, and I did that, let's say in 2012, and that's kind of a similar situation. Well, if an asset, in this case, a house, goes up in value, and my word, with real estate, if you're able to only put 10% down, 5% down, 20% down, you're taking an asset that went up in value and you're, highly, highly leveraged. Therefore, it worked out very, very well. And that's always going to be true, Jared. If an investment is a good investment and you responsibly apply leverage to it, it's going to look beautiful.
Yeah, but what this report doesn't say is drawdowns, right? Like peak to trough, how much was it down, right? So, if you're 2x levered a portfolio is down, 20%, the leverage one might be down 40%. So the wrong conclusion isn't, hey, okay, perfect, I'm just going to put 100% of my money in leverage small cap value because it has higher returns than the S&P historically, and it's cheaper than private equity. That's the wrong conclusion, right? Because the lived experience of this is very, very volatile, right? But just in terms of positioning and thinking about this asset class, okay, what is it really? So that when people say, oh, compare, that you're comparing it to the right thing and what's available in public markets. Justin, let's get to point number 2. And we talk a lot about this. How would listeners think about fees, right? And kind of like, how does that fit into the private equity conversation?
Let's repeat kind of a timeless principle, Jared. The returns that you experience are the returns of whatever you invest in minus the fees that you pay. And so in its simplest form, every investor should know, they should memorize, they should remember that fees will always erode future returns. And so you must be measured. You have to put a great deal of thought and intention around what type of fees am I paying. And Jared, when you think about public stocks to private equity, I mean, at the end of the day, I do like this conversation because it's a super helpful way for everyday investors to remember that, well, private equity is just buying a company, right? And Jared, that's the same thing you do in the stock market. You buy companies. And so, the fee profile is just going to be very different. Public equities has really had this, I don't think it's exaggerating to call it a revolution over the past 2 generations. And that revolution was really led by Bogle and Vanguard. And we have seen the everyday investor be able to access public stocks at unbelievably low prices. Fees have plummeted. I think you can make a case that there's never been a better time to be an investor, because you can simply be a passive investor in the greatest companies in the world, and you can pay next to nothing in fees to do so. So again, revolution is what has happened for the everyday investor in public companies. And so being an investor is becoming very, very good. Jared, that has not happened at all in private equity. It's the opposite story. Fees are absolutely massive. And so where should we kind of go from there?
Yeah. So I think the typical fund structure is just 10,000 foot level. Generally, and I would say fees are coming down in private equity, but painfully slowly. And fee variance is also very wide. But the typical fund performance fee, the fee structure has been 2 and 20. So i.e., there's a 2% management fee and a 20% performance fee above and beyond a certain threshold. So if you said, hey, above and beyond S&P 500, for example, we want 20% of the incremental returns above and beyond that. So the performance fee only becomes a factor if it reaches certain performance thresholds. But Justin, I mean, that's like an astronomical fee, right? Like if you're paying a 20% performance fee and 20% performance fee for, over the S&P, let's say the S&P returns 10% and we'll use a tangible math example. Private equity returns 15%. The S&P returns 10%. With the 2 and 20 fund structure, you get 2% right off the top. So your 15 is now 13. And then you get 20% performance fee of the 5%. So an additional percent off the top due to the performance fee. So you've taken 60% of the additional returns, eliminated them right off the gate, right? And so, and it's, again, in that illustration, it's still higher than the S&P, but again, the S&P is not your beta. Is not your bogey, if you will, or asset class you're going to be focused on. So, it's just a testament to, hey, man, what you pay really, really matters. And even really solid returning investments, if fees are astronomically high, like you need to be aware of that, because like Justin, you said this, the only returns that matter are after tax net of fees, right? Those are the only returns that matter, because those are the ones that
you get to keep.
Those are the ones those are the ones that make an impact on your financial life, right? Because that's your profit. That's your profit related to ownership in a business. So, it doesn't necessarily mean, hey, all investments are bad, but these fees, they create a crazy return profile or necessary return profile to even justify the incremental risk, lack of liquidity, and everything else related to investing in private equity.
Pretty interesting, Jared, that when you then take the net return after fees, I mean, you really are getting closer and closer to simple small cap public equities. Jared, I also think it's worth calling out. We don't get into predictions, right? We don't predict this is what the market's going to do. This is what investment XYZ will do in the next 5 years. But Jared, I do want to just mention that I think private equity returns face a little bit more of an uphill battle today than they did 10 years ago. Every single year, there are more and more private investors vying to buy the same businesses. Multiples that private equity firms pay for small businesses has gone up and up and up. And so, if you're in a fund and that fund originated in 2014, well, that is a very different environment. It's a different climate than if you are entering into a fund today. Jared, have we even talked about liquidity wise? So returns after fees, after taxes, You better have an enormous return if you're entering into an investment where you don't get liquidity for many years.
Yeah, that's right. It's like if you could get exposure with liquidity and exposure without liquidity, you should get there should be compensation to the fact that this is not liquid, right? So and that's kind of another issue with private equity is lockup periods are, years, and not even to mention additional capital calls that you could be subject to for additional investment. But you are not in the driver's seat. In most private equity arrangements, you are a limited partner, so you're an economic beneficiary, but have no decision-making beneficiary rights capacity. So you're really thinking about, hey, I don't know when I'm going to get this money back, and I have no say of when I get this money back. And because of that, there should be additional compensation above and beyond what you can get in public markets.
Absolutely.
Awesome. Justin, I think another thing we should talk about is the idea of like getting back to returns being ones you can eat, right? Like it's important to understand the timing of cash flows in private equity to understand your dollar weighted returns, right? So like private equity, there's this well understood concept called a J curve, right? So that means that capital is raised and deployed, and that here over that time period, that might take years for all of those things to happen, right? So like for example, if Justin and I were to start a private equity fund, we wouldn't have all the businesses we were going to buy day one. We'd have an investment theme or idea. Let's say Justin and I start the private equity fund for Texas middle market businesses. And so we say, hey, we want to go after companies with $10 million to $100 million in revenue in the state of Texas to support entrepreneurship in Texas. Great. We would start pooling investors for that. And we would also start vetting businesses to invest that capital in. But you might cut us a check to invest in the fund, but your funds might sit idly for an extended period of time while we look for these businesses, right? And so, your lived experience is an investment company or a private equity company might show their investment returns is, hey, look at what we've done, but also make sure these are, dollar weighted returns and not just, hey, we bought the company for X and sold it for Y, because your cash could be potentially sitting on the sidelines for years, right? Depending on how long and how the fund is structured and its deployment capital and how early you are in the subscription process.
Jared, and again, compare that to a public equity, whether it's a small cap fund or large cap. When you put your money to work in let's just say a small cap ETF, Jared, you hit buy, the order is filled in seconds, and you are invested in those companies immediately. That is a very, very different experience. And also, when you think about calculating returns over a long period of time, what you just said can matter a great deal. And so if it is, pick a point in history, let's say that, we're talking about a year or 2 year period where the market was up over 20% in each of the first 2 years of an investment. Well, then extrapolated 10 years later, that is an enormous amount of gain that if you're on the sideline, not invested during that 2 year period, well, that's a really tremendous force. And I mentioned extrapolating early returns over a 10-year period because that's not overly dissimilar than what a private equity investment might look like. And so if you are locking up money for 7, 8, 9, 10 years, it's important to understand that dynamic. Just how quickly will your cash be deployed and what will be the impact on your lived experience and your returns because of that?
That's exactly right. All right, Justin, next point. This one matters. This one's huge. I think I would say proceed with caution with private equity because diversification is more important and it's harder to get. I'll repeat that. Diversification is more important and it's harder to get. So there's a lot of published research which on manager dispersion, right? So, hey, what's the gap between the best performing and worst performing private equity? And comparing that to the gap is way wider than it is in public equity. So we have a piece of research from CAIS or CASE, I think it's called. And it shows the annualized fund returns and it looks at different asset classes. So for venture, we'll do buyout private equity. So the 75th percentile return of buyout private equity is 21.8%. Remarkable. The median is 13.6%, and the 25th percentile is 7.3%. So the difference between, getting in the top quartile and being in the bottom quartile, you're talking 14 percentage points per year.
Well, Jared, isn't it easy to just pick whatever's the top quarter percentile? Can't we just pick whatever's in the top, 25%?
Yeah. And so for context, that's for buyout private equity. For traditional public equity, the 75th percentile is 12.7%, and the 25th percentile is 9.3%. So 3 percentage points difference, with the median being 11.1%. So, even if so in both scenarios, there's upside to picking the right manager, but the cost of being wrong in the range of outcome is substantial, right? And to be clear, that is just manager selection. The other thing you have to think about is vintage selection. It's also well observed that managers will perform differently in different economic environments and different funds, right? So even if you pick the right manager, you could pick the right manager in the wrong vintage, or so you have to get a bunch of different decisions right? You have to get the right manager, the right vintage, and there's a lot of opportunity to get there. So because of this reality, you need to diversify, because the worst performing managers make owning private equity not worthwhile at all. But the problem is, to get the best managers, how are you going to build a diversified sleeve of private equity to make sure you get those best managers, right? It's a really convoluted process to say, hey, I want to build a diversified portfolio to ensure that I get those best managers. And it's really asking a lot to say, hey, I'm going to vet all these people, pick the best ones in hindsight, pick the best vintages, and pick the best managers. It's really hard to do. It's proven time and time and again in public equities that it's difficult to do. Private markets, probably even more difficult, and it's more important. So, it's just pointing and illuminating how hard it is.
Jared, few quick thoughts. So I'm kind of zooming in, like really staring at this thing. The lowest returns in private equity are pretty alarming. So again, what you said is picking the right manager is critical, but you hinted at something that is a very, it's worth repeating. This is so important. The way that you pick the right manager is not you become some savant at picking private equity managers. Jared, the way that you pick the right manager is you pick a bunch of managers, and you hope that one or a few of the many that you picked do extraordinarily well. And that's just really hard to do. Another call out here, Jared, you did mention, top quartile, 20% plus returns. So it's easy to hear that and say, well, okay, even if I'm middle of the road and average, I'm still getting better than public equities. Well, not when you add the leverage equation. You could just go buy leverage public stocks, which totally changes the return dynamic here and the comparison here. Jared, something that I find interesting, the more that you talk to families that have really significant amounts of wealth, so thinking, 100 million plus, the more that you really get that their expectation is they want to continue to find ways to consistently make 7%, 8%. I mean, a good half of the family offices surveyed in our 2024 Global Family Office Report, their expectations were 10% or less on a huge chunk of them. And so a lot of people are drawn to this idea that, hey, I'm going to pick the best private equity manager. We're compounding at 20% a year. It's interesting that most of the families with really extraordinary amounts of wealth have already kind of gone down that path, and their conclusion is, no, we're not chasing that. And again, this podcast is kind of the case against private equity, but in reality, we are right-sizing it. So I'm not saying that they depart and get rid of all private equity. That's not the case. And it is an important part of a portfolio, as well as private credit and other alternative investments. But it just means that you don't look at these returns and just chase 20% a year. That's not really a recipe for securely compounding wealth over really long periods of time.
And it's a different mindset, right? The investor who's looking for resiliency of returns, regardless of economic environment, is not the same person who's looking for the best returns in a specific environment, right? And so it's really just what are you solving for? If you think about institutions, if you think about endowments, right? They have great pools of money, and they're not betting the farm on things because they don't need to. And of course, they have exposure to these asset classes, but they're positioned accordingly, and they have a bunch of different parts of the portfolio that are going to perform differently than these. And yeah, they're going to take some bets, but they're not going to bet the farm on it because they don't need to, right? And so it really gets back to, okay, hey, what are you solving for? But Justin, I think one thing we didn't mention related to leverage, right, is like, hey, you need to be getting compensated for this illiquidity premium. And the other thing is, like, the illiquidity is going to kind of obfuscate like the real lived experience of volatility, right? Like, so one of the things about private equity is it'll tout returns, and it'll tout a Sharpe ratio, so risk adjusted returns that are way better than stocks. But the problem is, there's not an S&P 500 for all these small privately held businesses, right? So if the stock market's down, let's say 30%, but this small privately held business is also, is operating in that economic environment, but it hasn't gotten a valuation in a year. Is that business still what it was worth a year ago? Some of these private equity analyses might say, yeah, because we haven't updated the valuation, but we all know that's not the case, right? But these companies don't have the liquidity. So the other problem with the lack of liquidity is it creates kind of this confusing nature, this return profile that might not be reality because these things don't mark to market. And I would argue behaviorally, that's not a bad thing, right? Like, if my portfolio is down 25%, but I can't see that it's down 25%, it feels like it's not, right? Even though it absolutely is. And it's even worse than being down 25% because it's down and you can't sell it, right? So like, I don't think that's a terrible thing from a behavioral perspective, but it is just a reality that you need to acknowledge that, hey, when they show these really great Sharpe ratios or risk adjusted returns, the underlying assets in there aren't super liquid. So it's not an apples to apples comparison to say, hey, there was we returned X percent and never really had drawdowns. It's probably just not rooted in reality.
Jared, a little bit of an interesting case study would be to compare private equity to public stocks during the pandemic. So the 2020 pandemic, public stocks are down about 30% or so, depending on what sector and what style of stock we're looking at. But Jared, there are absolutely small privately held businesses that would have, if marked to market, would have been down 98% during that time period. And so it's kind of a good thing and an interesting thing. Just like you mentioned, it's really helpful as an investor to not see on paper, my private equity investment is down 89% this month because some wild, geopolitical or just any sort of event happens. And in this geography that I own these small businesses in, well, all of these businesses, if they had to sell today, would be worth way less. But it's helpful as an investor to, hey, it's not marked to market, and we're thinking in a decade-long time horizon. And so we're not freaking out during a difficult, tumultuous time period.
Yeah, I think, again, we're not against private equity. We just think it's important to right size it. And if you're a listener to this podcast and you are pro private equity, or you think you want to make the case for it, or even help us right size some of our accusations, we would love to hear from you. Again, we think, it has a place in the portfolio, but you just need to be mindful of these realities so that you make really good decisions, right? The decision-making framework for private investments is different than public investments. So it's just something to be aware of. But Justin, I love this conversation. I'm looking forward to tackling more of the alternatives in future episodes in greater detail. We'll share resources in the show notes. If you have ideas for future episodes, love to hear from our listeners. Podcast at brownleewealthmanagement.com. Thanks. We'll see you next time.